Want to take you through case study number 4. Hope you've enjoyed the first 3. This is for individuals who own and rent out commercial property and are therefore receiving taxable rent, and the planning here is to look and see what we can do to reduce the tax exposure and to make their situation a lot more efficient. So without further ado, let's have a little look at the scenario. Okay, so back to similar family situation as before. We've got Mr. and Mrs. case study. They own the property individually, jointly between themselves, but they do have 2 adult children. The parents who own the property are currently renting it to their own business, and their own business is ABC Restaurants Limited, so they are each receiving rent. And the rent in total is $100,000, so because they jointly own it, that's $50,000 each, on which they have to pay income tax. That's the situation we're presented with. The big question is, what exactly can we do and how can we help this fairly common situation that isn't being dealt with by existing advisors? So here we go. Step number 1. The first part of the planning is to establish a SSAS, a small self-administered pension scheme, using ABC Restaurants as the sponsoring employer. And at the moment, ABC Restaurants are paying £100,000 of rent for the commercial property, and that money is going into the hands of Mr. and Mrs. case study. They start the process of establishing the SSAS because they're both directors in the business. However, they are also able to add their grown-up son and daughter to the SSAS, turning it from a corporate pension scheme into a tax-exempt family trust. And this has important ramifications for inheritance tax planning in later case studies. But for now, we just establish a SSAS where we've got the 4 grown-ups as members and trustees of the SSAS. The next step is to move the property, and for any of those of you who understand about moving commercial property, we are going to glibly gloss over issues to do with stamp duty and VAT. We do have those covered, but I just wanted to let you know that we're not ignoring them. So, Mr. and Mrs. case study own a property jointly, and they're moving it into ABC Restaurants Limited that they also own jointly. And that transaction basically means that the 2 directors are now owed the value of that property because they're not selling it to ABC Restaurants. They are moving it in as effectively a director's loan. The next step is for the restaurant that now has the property on its balance sheet to move that across into the SSAS as a contribution, and that contribution triggers corporate tax relief. So now we've got a situation where the £100,000 of rent that was being paid to Mr. and Mrs. case study is now able to be paid into the SSAS. Same business expense as before. So as far as the company's concerned, the benefit to it is that it's had corporate tax relief on the property value because that's a pension contribution. The second thing is, from the family's perspective, all of that rent is now growing inside a family trust, which is free from tax because it's a pension. So the family can make investment choices inside the SSAS based on having £100,000 of rent coming in, and of course having a commercial property in there as well. The property is now exempt from inheritance tax. Remember, it started out being individually owned. Now it's being owned by a pension. So there's a number of things that can be done down the line to assist. The couple's personal tax situation has also been reduced. Prior to the planning being put in place, they were each on $50,000 a year of rental income. Now they're not. They are owed money as a director's loan, which is not taxable, and that has implications for their buy-to-let portfolio and for Section 24, which relates to tax relief on the interest on buy-to-let mortgages, which a lot of landlords have as a bit of an issue at the moment. Also, they have a director's loan. The company owes them the bricks and mortar value of the property, and that is an asset. That director's loan is an asset, and it can be moved into another structure, a QNUPS, qualifying non-UK pension scheme, and that director's loan can charge the company interest and not pay any tax on the interest. So there's other things that we can do beyond the surface of just moving the property around. So there we go. That's just a very quick run through of the sorts of things that we can deal with when we meet a couple who own a commercial property and they are renting it out to their business. And that was case study number 4.